Hi, so good afternoon. Today we'll continue with investing in financial instrument classes, and today we'll be focusing on equities. That's class 104. Equities. Yeah. So what is equities? Equities is ownership of shares, either by publicly traded or privately owned. So for private companies that are not open to the public, you can own shares of them, but they are privately owned. They're only disclosed to shareholders within the company. Unlike publicly traded companies where everyone have access to them via the stock market, and their results and other activities are also known to the public because they are available for purchase as well as sales from the public. Yeah. So stock risk level. So some people would say equities are low risk, some would say they're medium risk, others would say they're high risk. I would say some equities are medium risk, whereas some are low risk. So highly volatile stocks can be considered medium risk, as opposed to can be considered high risk, as opposed to less volatile stock, which you would call medium risk. Less volatile a stock is, obviously the less upside it will give you, so it will give you a medium upside. And the more volatile a stock is, the more the chances of you losing more or earning more. Thus, it is called high or aggressive risk. Example of a medium risk stock, let's take for Nigeria, we would say Dangote Cement. Yeah. If you look at the charts of Dangote Cement and Boa Cement, it's like a maze. A block. It's like building a blocks of wall, They don't go zigzag. They're not sinusoidal in a way. They just go vertical, horizontal, vertical, horizontal. That's how, if you look at your 1 year chart, is. So it stays at a particular amount for a while, and then it ticks up a bit. It stays at a particular amount for a while. So it's pretty much stable. If you look at a volatile stock, you look at probably Tesla. Yeah, let's use the US stock market. Tesla is most people that do options will say they do a lot of call options on Tesla. So a lot of sell options, They want to sell this stock because the stock can be highly volatile. I think it's a bit calmer now. When it first started with Elon and all this drama, that stock was solely driven by Elon at the start of trading of Tesla. But so stocks like that can be high risk. At this point, I won't say Tesla is high risk. I think they have attained a bit of credibility of having entered the S&P 500, and also their earnings justification for their valuation. So yeah, they are not, but there are really some highly volatile stocks. They just go sinusoidal, up and down, up and down, up and down. Maybe Ella Lakes. This year, I would say Ella Lakes have been like that in the stock markets. A lot of people are trading that stock, Ella Lakes. Maybe also Champions Beauty. If you have observed the stock market, you would also notice that, a lot of trading going on there. So some people don't trade. Most times traders are not attracted to medium risk stocks or less volatile stocks because the upside is not that much. When you invest in the stock market, it takes you 2% to buy a stock. You actually pay 2% of your money to buy a stock, and then you pay 2% of your money to sell. So if you are selling as a trader and you have not made above 4%, you're actually not making a gain. And so because of that, nobody would want to do that with a stock that is not very volatile, because you might just not be making money. You might think you're making money, but you are just not making money, because except the percentage is above 4, you are actually not making money. Types of stock exchange: the NGX, Nigerian Stock Exchange; the New York Stock Exchange, the NYSE; the Johannesburg Stock Exchange. We also have the Nasdaq Stock Exchange in the US. The NGX. The NGX is where publicly traded companies in Nigeria are listed. There are a whole lot of them. It's usually open weekdays except for public holidays between 10 a.m. and 2:30 p.m. Pre-market will be 9:30. After hours starts from 2:30 p.m. There's different type of stocks you would trade in the stock market, like I already said. Some stocks are medium stocks, some stocks are high risk stocks, and some stocks are for dividends. Dividends are aristocrats, so they increase the dividends yield of their stock every day. A good example is Zenith. I have followed Zenith stock and have traded and also invested in Zenith stock for a while. Zenith increases its dividends yearly, so its dividends yield increases yearly to match with its stock price. Zenith is a stock that I can say it does not cut dividends. Unlike some stock, you can't really say whether their dividends are stable or not. But for Zenith, I think over the years they've been able to, rather than cut dividends, increase or maintain dividends, which helps you. Things like that are good because it tells you can plan with it. You can plan with your Zenith dividends per year, because you know that this percentage is what I would most likely get per year, and with that you can get recurring or stable income from your dividends. So a good dividends aristocrats will be Zenith and maybe GT. GT also is not bad. Some other stocks pay dividends, but it's not stable. So sometimes they cut, sometimes they increase. I think UBA had to cut. A lot of people had high expectation for UBA interim dividends this year, but shocker, it was 0.25. Not really much to write home about. So if you're trading for dividends, you probably want to look at dividends aristocrats to trade in. So how do you get money from stocks? You trade stocks, you buy and sell. That's one way. You invest over a while, and then it appreciates in value, and you still have to sell either way to get money. And then you get dividends. Yearly dividends are a way of getting passive income yearly. The New York Stock Exchange, this is much more, not really complex, just more for more experience. If you have to trade, it's advisable that you are more experienced if you're trading in the US Stock Exchange. And the US Stock Exchange runs based on both technical and fundamental analysis. So you have to be also grounded in fundamental as well as technical analysis, especially if you don't want to lose your money. It's not okay. So the way the Nigerian stock market was, there's this safety net, which if a stock trade above or below 10%, a stock cannot trade above or below 10% in a day. So it cannot go higher than 10% or go lower than 10% in a day. So that's a safety net. So if you buy a stock, at least even if it's wrong, it will not go below 10%. So you can sell and then know that at worst, you lose 10% of your money. But in the US, there's no such safety net. You could see your money go to ground zero just in front of you. Example is Metal. After Metal earnings, Q3 earnings 2025, we saw Metal drop down to 13% in front of us. So it's a nasty game, but most times it's advisable. Invest for long term. Buy at there are skills that people use. There are a lot of trading skills. This is just general equity class. So if you want to learn more about trading skills, maybe we'll do another video on that. But this is just general equity class. Trading hours is 2:30 p.m. Now it's 3:30 p.m. because they are doing daylight savings till 8:30 p.m. or 10 p.m. Currently. Mondays to Friday too, except on public holidays. Accessing to stock, you get it through IPOs, initial public offers. So publicly traded stocks when a company wants to start trading on the stock exchange, it lists its stocks through the IPO process. Like you could see that Dangote said it was going to list Dangote Refinery 10%, 5 to 10% of it next year via an IPO in the stock markets. So initial public offer for inviting the public to buy into the stock. ETF, exchange traded fund. So, like I said, especially with US stock markets, stocks are not entirely passive investments. Unlike money markets and mutual funds, where you can just put your money market mutual funds, especially where you can put your money and you won't see a drop back. At best, your rates or at which the ROI will be reducing in percentages, but your capital is guaranteed. It's not same for stocks. Your stock, you could see your stock go down by 10%. You could see it also increase by 10%. So and except you sell or you buy, except you sell, you haven't really made money, so it is an assumed gain or an assumed loss until you make a purchase, until you make a sale. You get, so it becomes, so you could see 50%. My stock is 50. A lot of people celebrate. I've been holding this stock for 5 years, and they show you their portfolio and they say 60%. But hey, that is an apparent gain, because until you sell, you don't really have that money. And believe you me, when you trade in the US stock market, you could see a shocker that your really high percentage could be so dropped down by just a geopolitical news or something, so yeah. So to like reduce this risks, there's what we call ETFs. So people buy ETFs. So ETFs, when you bring a group of stocks together as one, usually characterized by industries. For like energy industries, you have energy ETFs. Cryptos, you have crypto ETFs. Semiconductors, SMH, you have an ETF for that. So ETFs bring different stock under the same industry as one. The idea is to spread the risks, as opposed to when you buy a metal and it falls down and you go down. When you buy an S&P 500, which makes up the top 500 companies in the US by valuation, when you buy that, it becomes very difficult for you to just, when you see, if you study the S&P, you would see that before you see the S&P drops by 10% once, that's massive, because like the entire market must be on fire for the S&P to drop by 10-20%. That's where you hear things like bubbles and then a crash. When the market is going 20% down, and what they are using is the S&P valuation, 55% down, 40% down. You do not see that, because it means mathematically that like maybe probably 80 to 90% of the companies in the US, the strongest companies in the US, are down in valuation. So that's why it is used to measure, because if you're looking at the top 500 companies in the US by valuation and also by earnings, not just valuation, but in terms of their results, they are also doing well. That's why most times when we want to tell people to trade, we say, well, if I was advising, I'll say, trade stocks in the S&P 500, because S&P has already done it for you. They've already vetted it for you and say this stock is worthy to be in our index. So trading them means, to a good extent, their earnings and valuation is justified. Yeah, so buy exchange traded fund to reduce the risks, like S&P 500, like industry-based stocks. So if you want to buy, you've been hearing a lot about semiconductors and chips, you might want to buy semiconductor ETF as against buying NVIDIA, so that you do not have so that a large swing down on NVIDIA does not necessarily affect you. Yeah. Types of ETF, like I said, okay, so there are energy ETFs, we have bond ETFs, we also have commodity ETF, gold. There are ETFs that mirror the price of gold. Gold is a safety asset, in the sense that when the stock market nosedive, most people veer towards gold. Some people are looking at silver too now, because everybody now knows the trick that gold is a safety is a safety net, so everybody's buying everything. I did the research. I was going to say to spread my risks by looking for the top stock in the Dow Jones, because I was trying to de-risk myself by looking for industrial based stocks, and I realized that the top stocks in the Dow Jones were just the same top stocks in the S&P. It was so funny. So at the end of the day, it's like almost everybody is buying the same thing. Yeah, so everybody's buying the same thing. So the only way for you to probably save yourself is diversify, which is what everybody seems to be doing. That's why you see gold rising, ETFs rising, Bitcoin rising, telling you that people do not understand where things are going, so they are just spreading the risk so that even if one asset class goes down, you still have others to keep you afloat. Perfect and really good idea, actually. Assessing US stock from Nigeria, you are looking at Bamboo. If you want to start assessing US stock, Bamboo, Trove, these are fintechs. Not to give credit to them, but they've been around for a while. Like 2020, they started during the COVID, and I would say that they have been afloat since 2020. Not to get all to give them too many thumbs up, but they've been afloat. And for Bamboo, they have moved even to 3 other African countries. They work with a US stock broker, Drive Wealth, and you can actually check your statements and confirm your accounts with the US stock broker website, on the US stock broker website. So hey, it might not be a bad thing to try them out. Ways to reduce risks while trading stock. Like I said, diversify your portfolio. Don't be in just one sector. Use different sector. It just spreads your risks. Stop losses. Yeah. So one thing is, how many percent, at which percent do you want to exit? At which percent do you want to sell off? It's very necessary, especially for traders. You need to know, so that when you eat, because unlike the Nigerian stock market, even the Nigerian stock market, GT was around 100, above 100 this year. GT currently is like 86 naira. That is crazy. It has gone down by almost 20 naira. That's almost 20%. So you have seen a 20% drawback on your stock, and that can be a bit scary. So if you're a trader, you use stop loss. If you're not a trader and you're investing, you do what we call averaging. So you buy at different price, and as the price goes down, your average price goes down. So when the stock picks up again, then it's faster for you to get on the positive. But you will need to pick very good stock, even in Nigeria. A lot of people, I saw a stock and they were selling it. This stock has just been lifted from banned by the by SEC. It's a Nigerian stock, and for some crazy reason, the value of the stock was going up. And I hear people saying they want to buy the stock for long term. If a stock has been held or unbound for long, why are you buying it for long term? You've not seen justification by results that this stock is going to do well, and you want to buy it and hold for it. Yes, obviously the stock price will increase because people are trading it. So give it a month or 2 months, you start seeing drawback because the traders are collecting back their money. And if you do not understand and you're entering that kind of stock for long term, when you're looking at a long term stock, you look at valuation. That's where fundamental analysis come in. You go and look at the past results. You go and look at their profitability. You look at their debt to earnings ratio, the liabilities to assets ratios. You look at all those things. Even when they say they are giving dividends, you look at how sustainable they can give dividends. Some companies are not profitable and they're just giving all their earnings as dividends. And there was a company like that, AT&T, in the US, that was giving really high dividends. But hey, most people knew that it wasn't profitable. It wasn't sustainable based on their results that they were looking at. Their assets could not cover it, and so it was only going to be a matter of time because people use dividends to cajole people to buy stocks. But if a stock is not fundamentally sound and their finances, the company's finances is not fundamentally okay, it's only going to be a while before it's like a bubble that's going to bust. Yeah, I think that's what they're saying about the AI. Dollar cost averaging, like I said, is another skill. You buy, if you're an investor, that's the best way to invest. You buy every month, buy at different prices, and then it comes to an average. Just buy good company. So we're talking about ways to manage risks while investing. I've talked about dollar cost averaging as a long-term investor, talking about Warren Buffett just saying, see, investing is easy. Buy good companies, hold for long. You can't go wrong. And that's the truth, because if you look at top 5 companies of the S&P over the last 5 years, I doubt their results have been negative. Look at Apple, look at Nvidia, look at Look at Meta, look at Microsoft, yeah, look at Alphabet. You know that, but people are looking for, I don't know. Stay informed on news, especially both Nigerian stock. Nigerian stock is beginning to get a lot of mileage and a lot of pull. So it's beginning to add up together because a lot of things. So when results are out, you see stocks pulling up faster in upsides. When companies are having acquisitions, you also see stock price increasing. That's a good thing, and you see also politics beginning to affect performance of stocks, which are not also bad. Equities, every investment come with some risks, or hey, I don't mean you shouldn't invest really. Not investing is more riskier because hey, ain't nobody know where the FX is going right now. So hey, you gotta invest. I think the bar has just been raising. So as opposed to when you can say, let me just save, it ain't working anymore because you just gotta invest. So yeah, equity is an investment class you might want to consider. Thank you so much for listening. I hope you used the knowledge to do something. Yeah, have a nice day.
Get started on your financial literacy journey today with EM Services Limited. Contact us on Instagram at EM Services Limited.